The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattelbaum. These are your headlines. AI valuation fears continue to linger over markets. Big short investor Michael Burry accuses hyperscalers of artificially boosting earnings, while Softbank shares fall after it sells its Nvidia stake and vows to double down on its OpenAI investment.
Infineon ups its full-year expectations for AI data center revenue, despite fourth-quarter earnings at the German chipmaker coming in slightly below forecasts. CFO Sven Schneider tells CNBC he's making big bets on the AI boom.
AI for Infineon is the power of the AI data centers. There is no AI data center without Infineon, and we are powering from the grid to the core, to the processor.
And Westminster awash with reports that the Prime Minister Sir Keir Starmer in the UK could face a leadership challenge, throwing the Labour Party into crisis mode just 2 weeks before its highest stakes budget.
Good morning, everyone. I'm going to pick up and talk about AI this morning because I think the market has been so fixated on this huge super cycle that's taking place. And naturally, these fears have been bubbling to the surface around whether we're overstretched on valuations, whether there are problems lingering in the system. And Michael Burry, again, taking the bat to some of these big AI names. To me, again, it's concentrated around two specific names, and that is Meta and it's Oracle. He's talking this time about the depreciation of the chip cycle, actually something we spoke about yesterday. It had come up through another company that had been reporting, but this time the focus on these companies about the life cycle of the chips they're ordering, whether that's appropriate, whether they've banked enough depreciation for the life cycle. He's saying they haven't. In fact, about $176 billion means that earnings have been inflated by that much across the industry on the back of not taking the depreciation charge now. So he's accusing them of some fairly creative accounting here. So that is another issue that he is pointing some spotlight focus onto. What you've also seen in recent days, and we were talking about it yesterday from the FT, about the financing costs, the credit costs, and whether we're seeing some improvement now in the premium that investors are demanding. The Wall Street Journal's picked up on that today as well, talking about the debt side of this story. So I think it's fair to say concerns are still growing about the AI story.
I think when it comes to Michael Burry, I mean, just for those who might need a reminder, maybe you don't, but the reason we all listen to Michael Burry when he says something like this is because he famously bet, of course, that subprime mortgages were going to turn into a crisis before 2008. So now here he is again, ringing the alarm bells on AI. So people are listening. I would argue, and I was having this debate with the producers for the show before we kicked off, what's the top story today? Is it these swirling concerns around AI? Is it the moves we've seen in markets with European equities continuing to hit record high after record high, the Dow as well, posting a fresh record? Or is it really that we're in a bit of wait and see mode for the market? And I would argue that we are in a little bit of wait and see mode. We've got the data coming out, which, Steve, you don't think is going to be that big of a deal, but we are waiting for macro data.
Did I say that?
You alluded to it.
Okay, that's not what I meant.
Well, I mean, that I'm paraphrasing badly. I think you don't think that what we could get in the data could derail the market.
No. I want to come back to both of you. I'll do it quickly here now. Yes, I think it could derail because I think the data is not going to be as pretty as people. But I think what it could mean though is more rate cuts earlier.
Okay.
So I think that's interesting. On your point and Michael Burry's point, let me try and be a bit controversial. I don't care.
About the Michael Burry point or the debt side?
Look, Michael Burry is amazing. He's brilliant. And I love the stance he's taken. I think it's fascinating. I think it's great. It makes a two-way market. But I don't care about the creative accounting on depreciating assets. I don't care about amortization and depreciation because that's an accountancy measure. So that isn't going to make or break AI. What's going to make or break AI is if they can translate the spending to revenues to profit. It is, quite frankly, as simple as that. Whether I have an asset which is worth $500 million or $10 million is not the point. Ultimately, stocks go up if companies make money. I don't mean to be very pure about this, but stocks go up if companies make money, stocks go down if companies lose money or don't make as much money as they. So whether my asset is worth X, Y, or Z on a balance sheet doesn't ultimately matter. What matters is whether that asset can translate into revenues, which translates into profit.
The problem with that is it's a bit too simplistic in my view. I think long term, maybe.
Well, I think simple
you're right.
is what makes markets ultimately.
Well, the problem is that you've got valuation concerns out there, and that is stopping investors from putting more money to work.
No,
at
Karen,
this
you
stage.
don't have valuation concerns out there.
I mean, there's AI valuation concerns. Simple. You're saying that in the marketplace.
No, you don't, Karen. That is exactly the point. When Palantir is trading on 200 times forward, when Tesla is trading on 200 times forward, when I'm seeing valuations going from 63 billion up to $500 billion to $1 trillion for the value of OpenAI in the private market, you actually don't have valuation concerns.
Well, the issue is you have to determine what the value of the asset is, and is the chip worth this or is the chip worth that? And we're talking not just about one chip, we're talking about millions and millions of chips. And to me, that is fundamental. You need to know what the life cycle of this product is so you can value it. And to me, that goes to the heart of whether we are looking at stretched valuations or not. If the life cycle is much longer than anticipated, then that is highly relevant in this market. And to your point, Juliana, about wait and see, I was saying earlier to Steve, I think we're in a period of analysis, not wait and see. I think this is very key. You're seeing this momentum still come into the European markets because investors do have momentum. They want to put money to work into year end, but they're not putting it into AI at this stage because they are concerned about the valuation issue. So for me, the movement is there. They're just being trapped in this analysis phase. I would argue that it's not wait and see.
I think I guess the test is going to be when we do start to get the macro data coming out of the U.S. We're also poised for the final vote on ending the government shutdown this week. So that a potential, I wouldn't say catalyst for the market, but obviously something to watch here. And just lastly on the AI point, I mean, we are focused right now on chips and the role that chips are going to play in building out the AI ecosystem. But energy is certainly a hamstring as well. And I think that is something that could come to the fore even more as these companies grapple with a massive energy shortage, and that's clearly going to constrain some of the growth here. Now, turning to markets, let's take a look at where U.S. equities ended the session yesterday. It was a fairly muted day for Wall Street. NASDAQ ending about 0.25% lower, so coming off a little bit overall. The S&P 500 ending about 0.2% higher. The Dow Jones posting a fresh record close, so outperformance in the Dow, a reversal of some of the trade we've seen recently where the NASDAQ has outperformed and the Dow has underperformed. But yesterday, the Dow posting a fresh record close. Overall, 10 out of 11 sectors were positive in the S&P. In yesterday's trade, it was healthcare that led the charge, 2.3% higher. Now, in terms of Treasury action, here's your look at how the Treasury market performed yesterday, bearing in mind that earlier in the week we had the Treasury market closed for Veterans Day. And right now we are looking at yields lower across the curve stateside. The 10-year currently trading just above 4%. In terms of U.S. futures, here's your look at the Wall Street Open for today. We're looking at a bounce across the board. The NASDAQ looking to add back just over 100 points or so at this early hour. Now, I mentioned in our conversation the U.S. House vote. The House of Representatives is back in session as members now return to Washington after a 53-day break to vote on ending the longest government shutdown in history. Now, this is the Senate approved a deal yesterday to extend government funding through to the end of January, with Republicans agreeing to hold a separate vote on health care subsidies, a point of contention for the Democrats. House Speaker Mike Johnson expects the bill to be passed this afternoon before it makes its way to President Trump. And on the data front, as we await the return of our usual data, we did get some private data yesterday. The U.S. private sector slowed in last month, according to estimates by ADP, which said the market was losing 11,250 jobs a week in the month leading up to October 25th. The data saw a rise in bond yield at both ends of the curve, with traders increasingly focused on private figures amid a halt of official data amid the government shutdown. Let's welcome Carl Weinberg to the show, chief economist, High Frequency Economics, to get his take. Carl, it's always great to hear what you're thinking. So let me kick off right now. We've been debating about what markets are focused on right now. What really is the top story driving the narrative here? What are you most focused on these days?
Well, I'm not really that concerned about the next data point or the last data point. I mean, we missed some employment numbers. We sort of missed some wayposts along the way. But the longer term story for the U.S. is that employment growth is slowing. And there's a question about why that is. A lot of people are concerned that we're seeing slowing job creation because the economy's slowing, and that's the way it's always been for most people throughout their lives and their careers. But others, including myself, and I suspect a number of Fed FOMC members, including Jay Powell, are thinking maybe the reason we're not hiring so many more people as we used to hire is because there aren't that many idle people left to hire and to put to work. We're hearing talk of job shortages, of labor shortages, of inability to hire skilled people or unskilled people for jobs across a number of sectors, especially construction, especially transportation and trucking, especially agriculture, especially some of the services areas, including healthcare. So the risk that I think the Fed is looking at is one that transcends what employment was last month or the month before, or CPI last month or the month before. But the question is whether we're just running out of space to grow because we're running out of people.
And Carl, to that point, is that the result of the changes to immigration policies in the U.S.? And I'm curious how you weigh those challenges in the labor market versus what we're hearing around a slowdown in hiring in white-collar jobs because of the impact of AI.
Yeah, so what we've seen in our data is that our civilian labor force is shrinking, mainly due to a drop off in non-American workers and immigrant workers. And we're down about 1.4 million people since the start of the year because of immigration, whether it's deportations, whether it's people not staying here, whether it's people voluntarily leaving here, whether it's H-1B visas. We're seeing less people coming to the United States, and that's been the source of growth of our labor force. And the number one driver of any economy, despite all the hype, it's not AI, and it's not investment in the stock market, but it's just simple growth of the population. You have more people, you have more mouths to feed, you have more houses to build, you have more clothing to make, you have more food to grow, you have more of everything is needed. And that's how economies grow. And these people work and produce stuff. So with a shrinking labor force, we're running out of workers. And without new workers, the only way we can grow is through productivity. And that's an uncertain course.
Carl, I appreciate your remarks there about the migration story and how that is impacting the US labor market at this stage. But what is the AI story around the corner? We've been debating it for at length around the set. And to me, what seems to be coming through is that it could be a youth employment issue. For instance, a lot of the big banks are not taking in the same amount of interns. The consultancy is the same thing. They're really cutting these entry-level jobs, using it across in other businesses as well, where they believe that they can do some of these white-collar jobs easier and cheaper with ChatGPT and the like at this stage. Do you see that coming as a problem down the line?
You know, in my career in finance, I've seen the finance industry extrapolate its own circumstances to the whole economy, forgetting that the whole economy is actually much bigger than the financial sector. If we read the Fed's beige book, it is filled up with reports from every district of companies trying to grow but being unable to find enough workers to do the jobs that have to be done. If we read the NFIB survey with its labor data out last week and its full report out this week, right, we see complaints across the board coming from small businesses that they would like to grow, they would like to hire more workers, and they can't. So yes, it may be some cutbacks in finance. There may be some cyclical concerns amongst the managers of financial companies. That's certainly true, but that's not the whole economy. And in the whole economy, the data that we've seen have been telling us that 96% of the people in the economy who are looking for work have work. And that means that if you want to grow, if you want to build a new factory to make America great again, you can't, because you can't find the workers to build the factory. And if you could build it, you couldn't find the workers to do the jobs that that factory would create. And that is a constraint on our growth right now.
Carl, what you're fleshing out sounds like an inflation story coming through in the labor market to me. And the reality is we now have some caution around the December potential for a rate reduction, with the hawks supposedly becoming stronger in their view that they want to wait it out. They think the tariff impact could be coming, some of the labor market issues you're fleshing out there. What do you make of the potential the market is still baking in for a rate reduction before Christmas?
Yeah, well, Karen, you heard Jay Powell say very clearly at his last press conference that a rate cut for December is not assured. Far from it. You heard him speak at that same press conference about the reduction in the labor force probably because of immigration, he speculates. Well, the market isn't always right. And in this case, I think that the market is off on a wrong foot because the information that we're hearing from the Fed, from a number of Fed speakers, is that caution is needed right now, that it's not clear that the economy is slowing, and that they need more data before they're prepared to cut rates again. And my view is that the next round of data will tell us pretty much what the last round of data it told us, which is that prices are rising, particularly prices for goods, that labor is scarce, that we're near levels of the unemployment rate that historically have been associated with full employment.
Carl.
Hi, Steve.
Hey, mate. Look, they've only given me one because we've got another guest after the break, but I'm going to make it a punchy one. Carl, you said that the market and the Wall Street and the financial community can't look beyond their own navel. My words, not yours. Mate, look, the US quarterly earnings season is underway. This is the best quarterly earnings in 4 years. 85% of companies are beating on third quarter results. Regardless of what's going on in the White House, regardless of what's going on with interest rates, the market is knocking, the real companies, not Wall Street, are knocking the ball out of the park, my friend.
So, I just heard you say pretty much the same thing, talking about AI, talking about how valuations could be wrong because you don't see a clear path to profitability. All right. Well, taking that same reasoning, the market could be wrong about the next Fed rate cut. Profits are high right now, and the market is strong right now. And historically, that has always persisted until it doesn't. Those of us who remember the dot-com bust, all right, remember that we went home at the end of 1 year with the economy booming, with the dot-coms going off the charts, and we came back to an economic catastrophe right after Christmas, right after the new year. Right? We can see markets pivot in a heartbeat, and we can see these profits change in a heartbeat with a change of investor sentiment. Similarly, we can see feelings about the economy, optimism about the economy, perceptions about the strength of the economy, right, change in a heartbeat. It takes more than one data point, perhaps nowadays, because we have so many data points. But in my view, with the economy growing so strong and with the unemployment rate so low, that tells me that we're heading to a collision between supply and demand. And if we get a shock to demand, or I'd say coming from the One Big Beautiful Bill Act kicking in January, coming in from tariffs being repealed by the Supreme Court and refunds landing in the pockets of companies and people in the first quarter of the new year.
Mr. Weinberg.
I think we are dangerously close to a point where we can't produce as much stuff as people want to buy. And that is, as Karen said, an inflation risk. And that's why a rate cut in December is not assured.
Mr. Weinberg, I'm glad I got the answer I did. I don't necessarily disagree with you, by the way, Carl. I just thought I'd rev things up a bit. Lovely to see you, my friend. Stay well. Carl Weinberg, Chief Economist at High Frequency Economics. He's good, isn't he? Right, coming up on the show, more records for stocks on both sides of the Atlantic, although the Nasdaq did struggle a tad on continued AI fears. Right, okay. And we'll break that down. Plus, luxury is back in focus with Singles Day and Black Friday shedding light on the health of the consumer. Charlotte is on the ground in Paris at the JP Morgan Luxury Conference, and we'll talk to the CFO and COO of IonQ, a leader in quantum, with a stock that has surged this year. No worries about that one's valuation. It's triple-digit surge this year. I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
China's 5-day Singles' Day shopping extravaganza has drawn to a close, with considerably less fanfare than in previous years. The world's second largest economy has faced deflationary pressures in recent months, and officials say weaker domestic consumption, especially among young people, has been a drag on economic growth. Chinese e-commerce platform Alibaba has not released data on its Singles' Day trading, whilst rival JD.com says it's generated record sales with orders up nearly 60%, although it did not disclose transaction values. The strength of the Chinese consumer is in focus for big luxury players as the holiday shopping season gets underway. Early this morning, Charlotte spoke to Chiara Battistini, the head of European luxury at JP Morgan, and asked for her view on the world's second largest economy.
I think it's early to call it a turnaround and a complete inflection, an underlying inflection. The base of comparison in Q3 was particularly easy, and we started to see an improvement on a very easy base. The improvement was also helped by the repatriation of spend from other regions back into China. So indeed, the signs from mainland China were positive. We saw an improvement of numbers there, but the overall cluster, when you look at total Chinese consumer and the total Asian consumer in the Asian region, was a bit more mixed, especially when you account for the easier comp. So it was definitely a stabilization, and that's also what the companies talked about, some stabilization and green shoots of some early signs of an improvement. To calling it a complete inflection and an acceleration, it feels like it's still early days.
Charlotte joins us now from the JP Morgan Global Luxury and Brands Conference in Paris with a special guest. Charlotte, I've got to say I've got conference envy being at a luxury conference and having these discussions. But the word that we saw out of China today was muted when it came to Singles' Day. So let me just get your sense of what you're seeing there, and we're looking forward to hearing from your guests.
Thank you, Karen. Well, a very special guest joining us now to give us a bit of a sense of where luxury is going at the moment. And look, Tapestry is the top performing consumer discretionary stock on the S&P this year. So stock is up 100% over the past year. And that's very much down to the performance at Coach. And so I'm very pleased to say that Todd Kahn, the CEO and brand president of Coach, is joining us here in Paris. So you've had a really strong performance. We saw in the results last week already. We know in the US you have a big moment, you have some viral bags as well. So how much do you see this momentum continuing and also entering into 2026?
Good morning. It's fabulous to be here with you. We had a fabulous quarter. We did 21% top line. We saw our North America business grow 26%, our China business grow in the 20%, and actually the standout was Europe at 39%. So we're just getting started. The sustainability of this growth and durability of this growth that we've demonstrated the last 3 quarters will continue into the future.
And Coach has been pointed as one of the winners of the big price hikes that we saw amongst a lot of luxury players after the pandemic, and a lot of aspirational buyers being priced out and actually coming back to brands like Coach or Ralph Lauren. So this is what you see, one of the key reasons for your recent success.
Actually, I think our success has less to do with the price delta between traditional European luxury and us. 20 years ago, that delta was 2x, 3x. Today it's 5 to 10x. So there is a difference. Our focus on Gen Z and their point of entry is material. We focus on that $200 to $500 price point, particularly when we think about that teenager going from adolescence to adulthood. That's a really important time in their life. We want to be their first bag, and we know if we can be their first bag, we have them as a customer for life. So it's very interesting, and what they love about us is they see the value and our values of expressive luxury, of enhancing their self-esteem and their courage. That's the sweet spot. Of course we have to be fashionable, but I'm less concerned what happens with traditional European luxury.
So, and that very first luxury buy is an important one. That very first bag, of course, is an important moment. But how do you build then loyalty? How do you keep then that consumer afterwards?
Yeah, I think sometimes we talk about it's like a first date. To get a second date, you have to have an amazing first date experience. Yeah. So we make sure we have that amazing first date experience. But when we look at the market in the next 10 years, there are 25 million women who turn 18. Every year who can afford a bag in our price point. So our primary focus is on acquisition. We know if we can acquire them successfully at the right price point, at the right time in their life, we have a massive retention. And what we're seeing with Gen Z, there's these myths about Gen Z that they're not loyal, they're fickle. Well, in fact, we're seeing a higher retention rate with Gen Z than almost any other cohort. So for us, some of the myths just don't hold true.
So let's look at the different geographies. Of course, your strength, the US market. How do you see the US buyer? Of course, we're entering a very important end of year season now. Has the US buyer been more resilient than we expected? This is kind of what we heard from other luxury players. Of course, at the beginning of the year, we thought the US would be a bright spot, then a lot of uncertainty because of tariffs. So how do you see the US consumer?
Yeah, I think there's always a disconnect between what people say and what people do. And if you don't realize that, just see how many desserts are actually ordered at a restaurant. So for us, we hear that the consumer is very choiceful. But because of our fashion credibility, our desirability, and our price points, we're seeing no resistance. If you're going to be choiceful this holiday and you want to buy a handbag, we see more and more people wanting to buy our tabby bag, wanting to buy, if they can find it, a Kisslock bag, wanting to buy a Brooklyn bag. It's compelling, the value's there, and so even in a choiceful consumer market, we think we win.
And how about Europe then? Because of course, the US market is your strength. You have a lot of household names here in Europe. You say you had 30% growth in Europe in the past quarter. How much of a growth opportunity is Europe for Coach?
Yeah, Europe is phenomenal. For us, Europe, we did actually 39% in the quarter, which is fantastic. And with Europe, what we see is the values of the Coach product really resonate. Again, and maybe there that price delta comes in even at a starker compare. We're just getting started in Europe. We've been focused on the UK. Now our next major focus is France. I mentioned to you we're opening a store in the spring in La Marais, which is exactly where young people are shopping. Gen Z go, they gravitate to that. So we recognize our sweet spot is to go into markets where the consumers are. And they don't always have to be where just traditional luxury resides.
Can I ask you about China? Because again, in the last quarter, we heard from different luxury players that things were at least stabilizing and that maybe we might be turning a corner. How are things looking for you in that region?
We feel great about China. We had double-digit growth in China last quarter in the 20%. That has been true for the last couple quarters. We've been in China for 25 years. And what's interesting is our sweet spot in China, particularly if the consumer is more cautious in China, really resonates for our customer in China. And our connectivity to China, the value proposition, but beyond the value proposition, we co-design in China. We have our largest workshop where our creative director, Stuart Weaver, works with Chinese artisans to develop some of our most important bags. So our connectivity in China and the price positioning in China is fantastic. And what we're seeing is, I travel a lot to China. When we talk about Gen Z, I was in Wuhan recently. Wuhan is a city, it has 1.5 million university students. Much more significant than Paris or even Boston in these states. We have 3 stores in Wuhan. We can build 9 stores in Wuhan just to service that market. So our commitment to China, our connectivity to China is very strong.
Can I ask you finally about tariffs? Because I know you have some production in Cambodia, the Philippines, in Vietnam. How do you mitigate this? And are you passing on some of that cost then on to the buyer?
Yeah. So 40% of our growth is international. So for international, those US tariffs that you're referencing have no impact. So overall, tariffs is an input. We focus on our price positioning for the customer and ensure that we give value. So there will be some price. We share some of the price increases with our supply base. We've started as a manufacturer, so we have a manufacturer mindset. Our manufacturer, most of them have been with us for 20, 25 years. So our connectivity to them is really dramatic. So there will be some price points, but our value proposition, when you can buy a tabby bag for $395, and that's the most sought after bag, we feel very good about where we sit.